Investors are awaiting some key economic news out of the U.S. We're right on the cusp of inflation tomorrow, retail sales. Of course, we'll think about how this factors into rate expectations. Right now, the market's pricing in a chance we're probably going to get another rate hike at some point this year. Let's put it all together. We've got Michael Green, portfolio manager and chief strategist at Simplify Asset Management. Michael, thanks so much for joining us. How are you thinking about, the economic data that stands in front of us and what this could mean for the Fed?
Well, I think we're waiting, obviously, for tomorrow's CPI report before we come to any real conclusions on it. Expectations are that the headline, which supposedly the Fed is ignoring, is going to tick up. We know the gasoline and oil prices have risen. You talked eloquently about that just a few minutes ago. On the flip side of it, we're seeing continued weakening and actually an acceleration of weakening in the housing market, where a combination of supply and rental units and very high interest rates on the mortgage side are beginning to hit the demand side of the equation pretty significantly. Those are very lagging components. We expect that they should be coming better than expected. But how the Fed chooses to react to that at its next meeting on September 19th and 20th is really going to be the key question. Jay Powell has told us he's going to ignore oil prices, or that oil prices are something that's not under his control. It's going to be interesting to see how they speak about the headline dynamics. Candidly, we just don't know yet what this is going to look like.
What is the bond market pricing in when it comes to the economic outlook, and how does that differ from what equity markets are pricing in?
Well, so I tend to react skeptically to the idea that anything gets priced in when we have such dominance of passive investing and systematic strategies. However, what we're seeing in the bond markets is expectations, about 40% probability that there is going to be one more rate hike. That tends to be well below the threshold that the Fed moves on. So the Fed tends not to hike unless there is a roughly 70% probability built in. Again, we will see on the September meeting where the Fed guides us, but my expectation is that most people are candidly accepting that the Fed is done for this cycle, that we're at the point where the pause occurs, and now it just becomes a question of how long are they able to hold that level of interest rates, and what do they respond to? Do they respond to the headline numbers, or do they respond to better data coming out of the core inflation numbers? We really aren't certain, because the Fed has changed its story multiple times in the past 2 years. But under this current component, what you're just seeing, I would argue more than anything else, is uncertainty. We're seeing high levels of implied volatility around interest rates. That means that a lot of money is basically being spent to protect against the uncertainty as to what the Fed's next move is.
And is that washing up on the shores of equity markets, which have wobbled recently?
I think that as the interest rates push to new high levels, that tends to create uncertainty, is the idea that the Fed is going to be very slow to react to equity market concerns. That is being priced in to a certain extent. But I don't necessarily think that the two markets are strongly integrated. I tend to think that money is allocated into equities based on systematic strategies. As long as people have jobs, we're seeing money flow into 401ks, et cetera. And so the very recent, what I would describe as, bobble close to all-time highs for the NASDAQ, feels like it's difficult to argue that anything is actually being reflected other than the narrative of we're about to achieve a soft landing. The Fed will have achieved an immaculate disinflation. I'm skeptical of that, but that certainly seems to be what markets are trying to price.
It's interesting with your focus on passive investing. I'm thinking about, this acronym, there is no alternative to the stock market, that pervaded for so long. Now there is in the bond market when you want to just return 5% or whatever it is of risk-free money. Is that a strategy that's just, is it playing out, or are people still, are they deploying it in kind of passive strategies?
Well, that's a very complicated question, but when you talk about there is no alternative, that actually is almost the reality. So if you think about how retirement saving typically works in the United States, you're automatically allocated into a 401k program, into something like a target date fund. That target date fund, in turn, does not change its allocations away from equity or bonds depending on their relative attractiveness. So when you say there is no alternative, that literally is what is happening. We have model portfolios and glide paths that are built into these They completely ignore whether equities or bonds are more or less attractive. Perversely, that can actually create its own dynamics. And I would encourage people to look at exactly what you're highlighting. Like, we're now actually looking at things like 30-year tips in the United States yielding above 2% in real terms. Historically, that's an extraordinary opportunity, and the equity markets don't seem to pay any attention to it. And I don't think they really can until people suddenly decide, hey, wait a second, I can inflation protect my purchasing power. I can generate a real return with zero risk looking forward. That should be something that is really, really compelling. But so far, we're seeing very few choose to make that active reallocation and override the models as they're currently written.
All right.